All right, let's just jump right in. We're looking at a week that could, and I mean really could, send shockwaves through pretty much every market out there. We're talking stocks, bonds, currencies, you name it. And yeah, that ripple effect is going to be felt everywhere, even in places as far away as India. The stakes? Incredibly high.
And I've got to be super clear about this. This is not your average week. Seriously. Behind the scenes, a kind of perfect storm is brewing. We've got this dense cluster of U.S. economic data and new signals from the Federal Reserve all hitting at the exact same time.
So, that all leads us to the big question, right? The one we're really going to try and unpack here. Is this the week? Is this the moment that makes every investor on the planet throw out their old playbook and completely rethink what's coming in 2026?
Okay, so to really get what's going on, you have to understand why the market is so jumpy to begin with. And the reason's actually pretty simple. When the U.S. tightens or loosens the money supply, global markets don't just react, they tend to swing, and sometimes they swing pretty wildly.
So what makes this week in particular so different? Well, it all comes down to the calendar, of all things. This isn't just one data release. We've had several huge, market-moving economic reports that got delayed or rescheduled, and now, wouldn't you know it, they're all landing in the same very short window. It's created this macro data pileup.
And just look at what's in this pileup. We're getting a fresh look at the U.S. jobs market, the latest inflation numbers with CPI, a snapshot of economic growth from GDP, and a feel for business sentiment with the PMI. So you can see the markets are being asked to digest a massive amount of information, a lot of it conflicting all at once.
And this right here, this is the heart of the problem. This is the market's big confusion. On one side, if the data shows the economy is running hot, well, that tells you the Fed has zero reason to cut interest rates. But on the other side, if inflation is coming down, that gives the Fed a green light to go ahead and cut. See the problem? They're pointing in totally opposite directions, and that creates a ton of uncertainty.
That confusion leads us straight to the main event, the big conflict at the Federal Reserve. And really, it's all about this growing divide between what the market is desperately hoping will happen and what the Fed is actually realistically thinking about doing.
So let's just get our bearings. Right now, after a whole bunch of rate cuts through 2024 and 2025, the Fed's key interest rate is sitting right here, between 3.5 and 3.75%. This is the number that basically sets the cost of borrowing money for the entire planet.
And here it is, the great divide. Over on the left, you've got the market. It's placing its bets. It's pricing in one, maybe even two, more rate cuts coming down the pike in 2026. But on the right, you've got the Fed's reality, and they're sounding way more cautious, hinting that they might just hit the pause button and wait to see what the data tells them. And that gap, that disconnect between what traders expect and what the central bank might actually do, well, that's it. That is where volatility is born. When those two different realities finally smash into each other, things can get really messy really fast. So let's zoom out and see how this whole thing creates a global ripple effect. And we're not talking about small changes. We're talking about a few key data points that could literally trigger the movement of trillions of dollars around the world.
So, the first number everyone has their eyes on is inflation. The consensus, what the market expects, is for the Consumer Price Index, or CPI, to land right around 2.5% for the year. That's the magic number. And the market's reaction here is actually pretty simple to figure out. If that inflation number comes in hotter than 2.5%, markets will probably sell off, because that means rate cuts get pushed further out. If it comes in lower, expect a rally, because investors will hope that cuts are just around the corner. It's pretty much that simple.
All right, the second big piece of the puzzle is jobs. The unemployment rate has been hanging out around 4.3%. This number is huge because it tells the Fed just how strong the labor market is. Now here's where things get a little weird, a little counterintuitive. A strong jobs report, which sounds like great news for the economy, right, can actually be bad news for stocks. Why? Well, because a strong economy tells the Fed, hey, we don't need to step in with that easy money from rate cuts. On the flip side, a weak jobs report can send markets soaring because it makes the case for those cuts much, much stronger. So, to see how this all connects to places outside of America, you got to understand something called global capital flows. The easiest way to think about it is like a giant tide of money that's always moving around the world, just looking for the best place to be. And the direction of that tide? It's almost always dictated by U.S. interest rates.
And this lays out the chain reaction perfectly for a country like India. Let's just walk through it. Say the Fed signals that rates are going to stay high, what they call a hawkish stance. Well, that giant tide of money starts flowing back to the US to get those safe, high returns. That means investors start pulling their money out of emerging markets like India. And when that happens, the Indian rupee and its stock market can take a hit.
So after all that, what's the big takeaway here? It's that you should think of this as a volatility week, not a trend week. We're probably not going to get a clear new direction for the market. What we should expect instead are stories changing on a dime and a lot of emotional reactions to every little piece of news.
So, as you're watching the financial news this week, this is probably what you're going to see. Sudden rallies on any good news, immediately followed by sharp drops on any bad news. You're going to see headlines that seem to completely contradict each other. And you're just going to see a lot of emotional, knee-jerk reactions from investors.
And that brings us right back to where we started. All of this chaos, all of this volatility, it all boils down to one single question that the market is dying to have answered. Is the Fed finally done cutting rates? Is the era of easy money over, or are there still more cuts on the horizon for 2026? Until we get an answer to that, well, you might want to buckle up.